Hello and welcome to the Hawaii Housing Report. I'm Patrick O'Neill with Luxury Homes International, and with me today, Hawaii's favorite economist, Mr. Paul Brewbaker. Aloha, Paul.
Aloha, Patrick.
Good to see you. Good to see you again. So I understand you are in a rather chilly place right now.
I'm in the Windy City where it was snowing on March 24th. A
It
wet
is
snow.
it is not snowing here in Hawaii, so it's
Yeah.
another beautiful day in paradise. Well, hey, we took last month off. So much has happened. Really interesting news on price appreciation figures. I thought real interesting news on the number of homes for sale. We also see inflation coming in a little bit higher than expected. Interest rates bounced up, and we have this big settlement of the National Association of Realtors that was just announced. But let's start with we're going to check in with the data from the Honolulu Board of Realtors. And this is something that you've been talking about for a while. And I'm going to pull up here the median price for February. Home pricing sitting right at 1,075,000. That's not a record, but it is close. We can see a little up and down, but I'm going to go to condo before we start this conversation. If we look at
Mhm.
condo median price at 512,500, again, we see single digit growth compared to year to date 2023. But this is really what I want to focus in on, Paul. Going back to pre-pandemic, pre-COVID 2019, prices year to date, if I do simple math, it's about 5% for homes, maybe 4% for condos. If I look
So you're
over
div
the,
you're dividing 26 or 25% by 5 years, and then you're dividing for condos 20% roughly again by 5 years, and you get 4 or 5%
yes, I know that's not
per annum.
perfect economist math, but just roughly,
Close
this
enough.
is, yeah, this is, and you've talked about this over and over again, long-term trend lines,
Mhm.
being around 4.5, 5%.
Yeah,
Is
in
this
fact,
sort
we
of
can.
confirming that right now?
Absolutely. Let's go back and look at your screen, just your screen share one more time, just so I can point out one more thing, the difference between the first tier of data, those single family data on the top, and then the condos on the bottom. Look at how the words differ. Single family homes, up, down, up. Condos, up, up, up. Let's do that again. Up, down, up, and then up, up, up. Aha! There's something there to look at. So
Hmm.
let me illustrate that for you and
Okay.
by sharing my screen.
And what was
The
surprising to me about that is knowing
Yeah,
what we went through in 2021 with the
yeah,
price appreciation, especially with single family homes.
yeah. You can see right here the longer term trend, as you mentioned a second ago, for Oahu is about 4 or 5%. That's actually the slope of that dashed line, which is about the same as you see. I've got some California markets here. Those are the airports, but San Jose, San Francisco, Anaheim, and San Diego. But when you look more closely at what's happened going into the pandemic in the 20 from the 20 teens and then coming out of the pandemic, you see a big overshoot on the single family side. We think part of that is remote work, but because of that overshoot, the single family home prices went up, down, and then up again. Whereas the condos kind of just went up, up, and up. I mean, they overshot a little. The trend lines you see there, again, right at the numbers you talked about, 4 or 5% on trend. So your simple math for the last 5 years is roughly correct. What's off a little is because of that overshoot on the single family side, it's the single family that have had higher appreciation post pandemic at 5% roughly per annum, as opposed to 4% for the condos. So bottom line here is everything seems to be settling back into trend. The one big difference is that single family prices are trending systematically above the pre-pandemic trend. It's as if there's a little shift upward and now they're just going to continue on those
Hmm.
20 teens trajectories.
Yeah, interesting. And interesting that despite what we've gone through with the interest rate increases, that it really seems to be keeping right on this trend line.
It's amazing that the trend has that the path of prices post pandemic, both in single family condo segments, have returned to trend which was true at 3% mortgage rates, and now it's 7 or 6.5% mortgage rates. So there's some fundamental underlying shortage of housing, if you will. I mean, the scarcity of housing in Hawaii is supporting those longer term valuations, even in the shorter term environment where interest rate volatility has been blowing headwinds and first blowing a tailwind and then a headwind into the face of home prices. Those home prices seem to just be right back on trend.
Yeah. And you bring up interest rates. Of course, this is the big topic, right, for all of us in the industry. So let's take a look. This was surprising. This was the last CPI index numbers that were released a few weeks ago, and they were higher than expected. And actually, it looked like inflation bumped up a little bit. Are we seeing a slowdown of the disinflation? Are we going to expect this to kind of be sticky for a little bit? Is this just a one-time blip?
It is observably sticky. I mean, the Fed's goal is to get this down to, this is the consumer price index. So the rate that would be consistent with the Fed's goal for the CPI would be 2.5%. The Fed's goal is set in terms of a different index, the PCE deflator, and that 2% goal is consistent with 2.5% on the CPI. But we're looking at a number that's like 3.5% here. And your question is, are we stuck at 3.5%? Are we going to get to 2.5? The expectation is that we will get there. But right now, what's causing this stickiness, ironically, is actually housing services costs, which, even though we can observe in mainland markets that rents are not increasing as rapidly, residential rents are not increasing as rapidly as they were a year or two ago when that overshoot was happening in Hawaii single family home prices, that slowdown in rents, I'm sorry, that slowdown in rental appreciation rates has not found its way into these measures of overall inflation. There's a fair amount of confidence that will show up this year. But if you listen to Fed Chairman Powell's press conference earlier this week, he made clear that it is their expectation it'll show up, and it is their expectation that when it does show up, the timing will be right for a reduction in the overnight interest rate target sometime in the second half of this year.
Hi, this is Patrick. If you're enjoying this information, please consider giving us a thumbs up below and be sure to subscribe so you don't miss next month's housing report. Yeah. Okay. And let's continue this conversation into interest rates and bring in Anders Hostelli, state manager for guaranteed rate mortgage. Anders, are you there?
I'm here.
There you are. All right.
Yeah.
Doing good. So we're looking at the CPI numbers here, and obviously this is something that you track quite often, and then how this is going to relate into the mortgage market. Right now, the rates we're seeing at Fannie Mae are up at the 6.8, almost 6.9%. After what was that, October, we were at almost 8%. We bounced down almost to 6, and now we're back up around 7. Where are you seeing the 30-year track right now, Anders?
Yeah, again, as I always say, it all depends on down payment and credit score, but it's kind of right in the mid sixes right now. Somebody with good credit, with a standard down payment, so it's a little bit lower than what we're showing here. I mean, it's a nice, it feels like buyers uh, have gotten just used to these types of interest rates, right?
I
So last
see.
year there seemed to be, rates kept moving up, and why am I, rates are so high. But sometimes it's good when rates bump up and then they come down a little bit, right? So then they're like, hey, it's not that bad, right? It's not as high, like you said, as it was back in October of last year.
I see. So right now you're seeing rates, you're looking at your screen right now, mid sixes, which is an improvement even over last week.
Yeah, yeah, it's mid sixes is
Ah,
see. Yeah, yeah.
okay. Well, that's good to hear. And then what about adjustable rate mortgages? Where are those pegging?
I mean, I'm looking at our adjustable rate mortgages. I mean, they're in the mid sixes as well, maybe lower sixes, depending on the term. But yeah, it's not much lower than a 30-year fixed rate.
Okay. And there's a gentleman that watches the report by the name of Ed. Ed, thanks for your email to me. And he brought up something that I know you're well aware of, and certainly everyone in the real estate industry is right now. It's
Mhm.
the insurance issues that are affecting
Oh, yeah.
condominiums, maintenance fees, but also they're affecting the mortgage loans. There's the underinsured problem and the deductibles. Could you explain that, what those issues are?
Yeah, what we've seen over the last more than I mean yeah, more than a year is that insurance costs are really going up. The Maui wild the fires in Maui, what happened there, and the claims that were had to be paid by insurance companies. Also, just nationally, right? All the weather events. So it just it's made insurance just more expensive. And we've seen it where also some insurance carriers have pulled out, or they actually will only insure up to a certain amount on a condo per se. We call it a sublimit for hurricane, which isn't acceptable for lending standards. So what happens is there's a sublimit. I've seen it where now an association then has to get a supplemental insurance to cover the remainder to get up to 100% replacement, and it's very expensive. We're
And this is
seeing
because the Fannie Mae, Freddie Mac, secondary mortgage markets will not lend unless there's 100% coverage. Is that
right,
right?
exactly, and the local banks follow those guidelines as well. So yeah, so then you're seeing, like I saw one last week. Somebody showed me one where they had the sublimit for hurricane, but then the supplemental insurance for hurricane to get up to 100% was like almost $250,000 extra. And that's an annual premium. Then you divide it out, on the as far as maintenance fees. So maintenance fees can be doubling or even more than doubling um,
Right.
on
And we've
a
seen that.
condo project.
And can you explain the issue with the deductibles? Some
Okay.
have 100% coverage.
Well, what we've seen is some projects have, they now have they had a sublimit, but in order to get the 100%, they got 100%, but then they raised the deductible. And that deductible, the standard deductible that's acceptable is 5%, a 5% deductible. And we've seen some where the condo now has a 10% deductible, which makes that project ineligible for
Boy,
saleable financing or maybe the local banks. Maybe there's some non-QM or some other lenders that would still lend in the project, but at a price, right?
yes. Oh boy, I see. And if anyone's watching and you're having these issues, I do know that Guarantee Rate has some programs that can help out with those. If you're interested, reach out to Anders on that. And Anders, looking at loan originations, loan locks, which is just a good measure of the health of the market, are you seeing any change? Has there been any change over the last month?
Yeah, well, there's been an uptick, definitely an uptick in locks. Now, that's sort of, even cyclical. You'll see that usually the end of the year, January, beginning of February, it's kind of slow. People get their, either credit card statements. Oh, I better maybe do a cash out refinance, or they're kind of planning for spring. I want to move in springs, or so we can move in over the summer. Kids can go, new school, things like that. So
Hmm.
we've definitely seen an uptick. Yeah.
Okay. Well, that's good to hear. I think we're seeing that also through our company, the amount of transactions. So that's, I think, good news for both buyers and sellers. And then we have not had a lot of success on the speed round with the
I know.
forecast into
Right.
interest
Right.
rates.
Yeah.
But I'm going to ask you anyway. Speed round.
Uh-huh.
Okay, here's your first
Uh-huh.
question. Higher,
Sure.
lower, about the same. Interest rates 6 months from now.
Still gonna see a little lower. Still gonna see a little
Okay,
lower.
let's just keep saying that. It's going
I'm
to come
kicking it
true
down. Yeah, yeah,
eventually.
yeah.
1 year from now, higher, lower, about the same.
A little lower, a little lower. Yeah,
Okay, all
yeah,
right. That's eventually we're gonna get
yeah.
there. We're gonna be
Yeah,
right
I'm
on
right.
those.
Yeah.
Yeah, that's right.
Thanks for
Anders,
having me.
thank you.
No.
Yeah, thank you very much. And thanks for giving the real world what's happening right there on the spot. And thank you again for sending all the data that you do throughout the week. Both Pont, I really appreciate it.
Thank you.
Take care. Alrighty, bye-bye. All right, and a big thanks to Anders Hostelli, Senior VP at Guaranteed Rate. It's great to have him on. I always like hearing the on the spot. What's the interest rate right now? And he's looking at his screen. And then, Paul, do you sort of agree with the idea right now that we're going to be kind of in this environment for a little while, talking about interest rates? And then what will the effect be as we start to look forward in the closed sales area?
Yeah, I agree with Anders, and I think most people that interest rates, it'd be great if interest rates would fall faster, and they're not falling as fast as I thought. And but either way, the fact that the Federal Reserve expects their target rate, the overnight rate, the Fed funds rate. This is the Fed's projection from December. They published a new one this week. I haven't updated, but their expectation has been that interest rates would decline over the next couple of years. And when that's true, then you expect to see sales move in the opposite direction. Now, what I've done here is I've turned upside down the mortgage rate, which is the
Really?
dashed line in red. Yeah. So when
Hmm.
the mortgage rate's going up, in this picture, it's actually going down. And you can see it going from 3% up to 7%, which is down here. When the rate moves, home sales move in the opposite direction, but here I've inverted. So they're basically following that mortgage rate up, which is down. And if you think about Anders and myself and the Federal Reserve expecting interest rates gradually to decline, moving from 6 or 7%, maybe down into a 5 range by the time we get into next year, then sales volumes as well should track upwards gradually, but back to something we're familiar with from the late 20 teens.
Interesting how close that tracks. Um,
It's I have to explain that I could make it look like this, but I didn't have to. So if you, I've been very careful to make sure the scales are not perverting the relationship. It's a very tight relationship. Other factors matter, and Anders described, your income matters, your credit score matters, these exogenous insurance costs. There are a lot of factors that matter along with the interest rate. But that movement of interest rates and sales together is a really striking factor if you're thinking about where your business is going over the next couple of years.
yeah, and this is the information from the Honolulu Board of Realtors. We'll take a look at this. These are closed sales year to date, and there were two things that really jumped out to me about this. The difference of year to date 2019 in the single family home space, we're only down 20%. That doesn't seem like the dramatic volume decrease that I hear out there in the world. Of course, compared to 2021, it's a different story, and even early 2022. And then the condo market is down only 3%. I mean, that's almost the same type of volume.
Yeah, that's as you say, when those 3% mortgage rates were available in 2021, 2022, there was just a feeding frenzy. And so we're down a lot from a really low interest rate environment. But if you look at a rate environment that's somewhat more normal, the one that was true in 2019, we're not that far off. I mean, we're within striking distance over the next couple of years as mortgage rates move down, and the Federal Reserve moves to normalize monetary policy.
Yeah. Okay, then Paul, we're going to talk about the number of homes for sale. And as I said earlier, this was something to me that was kind of shocking to see the numbers we're going to take a look at right now. So these are active listings for sale. This was the month of February. And I'm just going to kind of get to the punchline on this. These are single family homes. Compared to 2022, February of 2022, there are 72% more homes on the market right now for a buyer.
Mm.
That's a lot more homes than there were in
Well, they were
2022.
they were getting snapped up pretty quickly 2 years ago at low interest rates and before the Russian invasion of Ukraine.
That's right. And now if we go back to 2019, pre-pandemic, we can see there's 60% less homes on the market today, and that's no surprise.
Yeah, yeah.
That's the effect of that lock in on the interest rates, that
Yeah,
sellers aren't selling, and it's slowing the whole market down.
just yep, exactly.
Yep. And if we look at condos, we see the kind of the same phenomenon. There are 40% more condos on the market right now than there were in February of 2022, but there's 40% less than there were in 2019.
Mm.
I mean, it's not a surprise, but it's a pretty shocking big difference, don't you think?
It's yeah, that's how much dampening of of buyer ability and seller enthusiasm has come with the higher interest rates, even though rates are starting to trend downward again.
Right. But if you were a buyer in 2022, you have almost twice as many homes to look at and 40% more condos. So I guess that's
Yeah.
good news in one stretch. And then all of this is really going to come down to interest rate, right? Before this kind of log jam opens up.
Yeah, I mean, logjam is a great way of thinking about it because even with Anders starting to offer mortgages in a mid sixes, 6.5%, that sounds like really good money compared to whatever it was, 7% at the end of last year, October or something like
And
that.
nearly eight.
Um,
Yeah.
and oh, I'm sorry, seven? What did it have a seven? It got so high, it's like
Yeah, it was in the high sevens, almost. It actually tipped over eight in
7.8.
the middle of the day.
Yes,
Yeah.
there
Yeah.
you go. So we're down from a number that's close to eight to one that's 6.5, let's say, if you call Anders. And that's got to be bringing back some interest. But again, on the buy side, but on the sell side, there are a lot of people trapped in a 3% mortgage that would have to, move. I mean, if they have to get into a reprice at a 6.5%, makes them reluctant to get out there, and therefore the inventory, as you say, is down substantially from when it was in a more favorable interest rate environment. Prospectively, though, where we're going is a 10-year treasury yield that's come down to 4.2% now.
Hmm.
And so if a mortgage, that's still a 230 basis point spread at 650 to a 420 mortgage. That's still a little rich. So there's room for the mortgage rate to come down. That expectation likely will be validated as the Fed, having made pretty clear they expect to reduce rates later this year, contingent on progress towards somewhat lower inflation. As that validation occurs, you'll have a third factor, which is spring and summer. It's a seasonally important time of year for home sales transactions. So, people should be sharpening their tools and getting ready to see what comes over the next few months. I think it might be a kind of an interesting summer, and
Yeah.
then even more interesting as the lower interest rate validation proceeds.
Right. That would be nice. Have some good news. Let's have some good news this summer and see the sales volume start to clank up a little bit.
About
Well,
time.
yeah. Paul, thank you very much for your time today, all your insight. For those of you who are watching this, if you enjoy it, please give Paul a thumbs up down below and consider subscribing so you don't miss next month's Hawaii Housing Report. So until then, be well, be kind, and aloha.